All right, if we're going to talk about the different order types there are and the way orders are crossed and prices change and the order book itself, I thought the best place to start is just looking at an example of an order book. So this was, I think, I don't know how many years ago, let's say in 2018 at one point, what an order book at one of the Bitcoin exchanges looked like. So on the left-hand side, we have all of the orders of people standing around looking to buy Bitcoin. So someone is offering to buy 2 Bitcoin at 91.56. Someone is offering to buy 6 Bitcoin at 91.5550. Right? This is the buy side. So these are all bids, because again, it's from the perspective of the people placing these orders on the books. Notice the prices for these are always going to be higher, or should always be higher if the market and exchange is functioning properly. So we have 2 Bitcoin looking to be sold at a rate of 91.57, and then we have 7 more Bitcoin looking to be sold for 91.5750. Now the midpoint price here is there we go. That's the slide I want. The midpoint price is a very special price because it is the market's best estimate of the true value of the asset. So remember when I gave the example about selling pencils, the only real relevant price was the best price, right? If I sold pencils for 100 and Walmart sold them for 10 cents, the fact I'm selling them for 100 doesn't matter. Similarly, when we look at the order book, the most important prices are this one, the 91.57, the lowest price that someone is currently willing to sell anyone Bitcoin at, and this order, the highest price someone is willing to buy Bitcoin at. Those are the most important because those are the 2 best prices, depending if you want to be a buyer or you want to be a seller. Now, because those are the 2 best prices, those are the 2 currently relevant prices, and the price right in between them, the midpoint of these 2, is the market's best estimate of the true or fair value of this asset. So this is one of the ways that the market helps us value assets. And often in stock markets, these valuations are quite precise. The difference between the best bid and the best ask is small. By the way, these 2 prices are called the NBBO when you trade stock normally, or the National Best Bid and Best Offer. For some reason, it's customary to call asks, like selling orders, as offers, which I don't necessarily like that terminology, but that's the way it is. Okay, so a quick word of warning. You're probably going to need to look at parts of this video numerous times. Some people get this quick, but others struggle with it a lot and just have to go over the examples over and over. Go over it slowly, think about what makes sense in terms of when orders execute, and you will get this stuff. But it's pretty fundamental, so take a little bit of time now if you need to. A market order is an order that is executed immediately based on what the current orders standing on that order book we just saw are. So, for instance, if you send in a market order to buy, you are sending a market order to buy, which means that someone else is selling it to you, right? So this would be the column we're looking at. You are buying from the people who are sitting there waiting to sell. If you submitted a market order to buy 1 Bitcoin, it would transact at this price, the best price that you could buy it at, the lowest price that you could buy it at, which is 91.57. Similarly, if you submitted a market order to sell, you would sell 1 Bitcoin for 91.56. That's the highest price someone is looking to buy Bitcoin from you, from an outside investor. So this is a very standard order type used by retail traders. Retail traders are often not super price sensitive, so they just say, oh, I want to buy Tesla, whatever. Buy it. Market order to buy. I don't really care what the price is. I want 10 shares. And then they buy it. Now, a limit order is a price contingent order. So you specify the price that you are willing to pay for it. So if you have a limit order to buy at $5, it means that you would be happy to buy the asset for $5 or better for you. Always think about what is better for you. If you are buying something, you want a lower price, right? So a limit order to buy at $5 means you would buy at $5 or less. Where if you put on a limit order to sell at $6, let's say, then you are saying, I'm happy to sell this asset for $6 or more, because you're selling, you want the higher price, not the lower price. Okay, we're going to look at a few examples of this and kind of illustrate how a large order could end up being filled at multiple prices. Okay, do I want to talk about, sure, we can talk about trading costs, I guess, first. So, when limit orders go on the order book, or excuse me, when you submit a limit order and it doesn't transact because there's not an order standing on the book already for it to transact against, it gets put on the book and stands there until someone else comes along and transacts against it. And we're going to go over examples of this. This will be much more clear in about 10 minutes. Brokerage commission is an explicit cost you pay to your broker. So you say, I want to buy 10 shares of Tesla, and your broker says, absolutely, you got it. And we're going to charge you $1 for that service. So you got to worry about brokerage commission. Fairly recently, in 2019, I believe, end of 2019, brokerages got in a pricing war and cut their commissions and cut their commissions and kept cutting them. So actually a lot of retail brokers offer commission-free trading now. Although, as we'll learn later, you might pay for your trades in other ways. But this was started from Robinhood. Robinhood was the first brokerage to offer commission-free trading, and they have a really brilliant business model. We're going to talk about how Robinhood makes its money. I would actually love for you to think about that. That's the type of thing where if you want to be a trader, you should maybe be able to figure it out, or at least think of possible reasons. You should always be inquisitive about the universe, or in finance and business, about businesses, how they make profit, where their profits come from, why they do this, why didn't they choose some other model. So the Robinhood model was very interesting, I think brilliant. So we'll talk about how they make their money a bit later. Now the other way that you pay money trading is because of this implied cost of trading, which is the spread between the bid and the ask prices. And how this works is if you buy a stock and immediately turn around and sell the stock, the price that you can buy the asset for is higher than the price that you can sell the asset for. So you immediately lose some money in this turnaround transaction. Let's jump into some examples because I'm sure there's a lot of confusion right now. So let's clear this up. Let's say you submit a market order to purchase 11 shares. We'll do some market order stuff first, and then we will look at more limit order stuff. So again, we're looking to purchase shares, which means we have to look at the side of the order book that people are looking to sell us shares. If you are demanding liquidity from the market and demanding a trade now, you're executing on the higher side of the order book. If you're buying, right, you're going to be buying at a higher price than the price you could sell to the market at. That's the slower part. So, okay, a market order to purchase 11 shares. Well, we get 2 shares right here, 91.57. Then we get 7 shares at 91.57.50. Now, we've gotten 9 shares out of the 11 we want, and this was Bitcoin, so whatever, call it coin shares, doesn't matter. So we still want 2 more shares, which we're going to get at 91.58. Now, when this happens, these orders that were sitting on the order book waiting to transact, they're gone. They get matched with our orders and they leave. So these 9 orders combined here, the 91.57 is gone. This 91.57 is gone. And this 91.58, instead of having 4 shares available at that price, you bought 2 of them. So there's only 2 shares available at that price. So now the best bid is still 91.56. That's unchanged. But the best offer jumps from 91.57 up to 91.58 because these two orders are removed from the order book. All right, let's look at a limit order example. If you submit a limit order to sell 100 shares at 91.52.50, again, slowly think about this. If you are selling, if you're trying to get an order that transacts right away, you're selling at the lower price here. You're demanding liquidity. You can't just sell at a high price and turn around and buy at a low price. That wouldn't make sense. It would be great for you if you could, but that wouldn't make sense in terms of markets being efficient and markets operating correctly. Okay, so you submit a limit order to sell 100 shares at 91.52.50. Notice that this limit order to sell at this rate means that you would sell for 91.52.50 or higher, right? You are happy to get a higher price if you are a seller. You would love a higher price. But this is the lowest price you'd be willing to sell Bitcoin for. Okay, so what happens in terms of this order book? You actually don't immediately sell at this price, 91.52.50, because there are people who are already here standing around waiting to buy shares from you at these higher prices. So you sell 2 at 91.56. You transact against these 2 orders that are on the book. You sell 6 at 91.55.50, right, going down the book. Another 4 at 55, another 5 at 54. This goes all the way down until we get to this point here, which is the last order you would transact against on the book, because that is your limit price. 91.52.50 is the lowest price you are willing to sell at. So you clear all of these orders from the order book. All of these orders leave. This is where things get kind of interesting. This does not sum to 100 shares. How many shares is this? Let's see. 10, 17, 26, 40, 50, if I count right. You've only gotten 50 shares sold out of the 100 you wanted to sell. So what happens to the other 50? The answer is your order for 50 shares, which is not transacted, gets put on the sell side of the order book. So there would then be a 50 here, and that would be your order waiting to transact. You want to sell 50 Bitcoin at 91.52.50. So the ask goes down from 91.57 to 91.52.50 because you currently have the best ask in the market. You are standing there waiting to sell 50 shares at 91.52.50, which is the best price now. So the ask jumps down to 91.52.50, and since all of these orders are cleared because of your trading, the best bid is 91.52. So the price of Bitcoin moves down, right? You've changed the price by about $4 or $5 by doing this trade, which makes sense. Think about it like this. There's this tremendous order to sell. If someone is demanding to sell a lot of their shares, of course that's going to drive down the price of stuff. If people want to get rid of the asset, the market is going to think the asset is worth less than it actually was. Please go through this carefully a couple times to make sure you understand it. We'll have a number of homework problems with this, and I guarantee you we will have problems on the exam with this. But this is just the type of thing, if you want to do any kind of trading at all, you have to know this cold. Okay, one last order type I want to talk about. I might talk about some exotic order types just because I use them a lot in my trading. I'm kind of a specialist when it comes to these more exotic order types. But for now, stick with what's basic. There is an order called a stop order. And the way a stop order works is your broker does not give the order to the exchange until the traded price of the stock hits a certain trigger price. and that trigger price is called your stop price, which you set. Usually stops are used to limit downside risk. These are called stop loss orders. Let's give you an example, so once again, clear up confusion, because I know when I just say what the definition is, people are like, what is he talking about? I don't get it. All right, so let's say we have a stop sell order at 50. What this means, if you have a stop sell order at 50, is your broker will submit this order to sell only when the market price is 50 or below. Think about how this would work. If the stock is above 50, the exchange never gets your order to sell. But if somehow the price is below 50 or hits 50, trades right at 50, your broker then triggers your order and your order goes on the books like normal and then transacts. So let's say, just hypothetically, the price is already below 50 and you submit a stop sell order at 50. Your stop trigger is $50. This is the same as a market order, because what the brokerage does is it checks, is the price 50 or below? Yes, it is. Submit the order to the exchange, right? And it's a market order, so it just goes on the exchange like normal. What is a different scenario is if the price is currently above 50, because in this case, your broker does not submit your order. It just holds on to it and waits and watches the stock. And once the stock price hits 50 or jumps below 50, which there can be a risk associated with that, we got to be careful. Then your broker says, okay, dump the stock, unload the stock. It's fallen to 50, and so we want to get rid of it. The reason you would do this is because it protects you from downside risk. So for example, let's say we'll stick with what's in the slides. I buy a stock and it's currently at 60. And I want to limit my downside risk. Let's say I can't afford to lose 100% of my investment. I buy 100 shares at $6,000 position, and I don't want to risk losing $6,000. Well, what I can do to limit my risk is say, okay, I'm going to set a stop loss at 50. So what happens is the stock might be falling a lot someday, and when it hits 50, then my shares are dumped, and I sell those shares at 50. Now, it sucks. I took a loss. I bought at 60, and I sold at 50, so I lose $10 a share. I end up losing $1,000. However, I'm not going to lose $6,000, right? I unload the shares at 50, and let's say that day, the stock just drops, straight line down, from 60 steadily down to 40 at the end of the day. Now, we don't know this for sure, but let's say this happened, hypothetically. I would be very happy with my stop loss because it protected me from the further $10 per share loss, right? I sold it at 50 when the price hit 50 instead of at the end of the day when it was at 40. So I saved myself $1,000 by having the stop loss. Words of warning, because there is never some free benefit in the finance markets. Everything comes at a cost. Think about when this would be bad. In fact, pause the video right now. Think for 5 or 10 seconds when you could get screwed over using this kind of trading, using this kind of order. You will lose big if the stock temporarily drops down, and let's say it just touches 50, and then surges back up. Let's say the stock drops from 60 to 50 and then goes to 100. Well, because you have a stop loss, what happens is you sell the stock at 50, right? You unload it. And now the stock goes to 100, but you no longer have it. So instead of getting a $4,000 gain, in this case, which is what you would have had if you didn't touch the stop orders at all, you have a $1,000 loss. So you do risk losing a lot of upside in the form of the stock price touching your stop loss, you unloading your position and closing your position, and then the price moving in a way that would have been very beneficial for you had your position been open. Another thing I have to mention, and this is more my practical trading experience, this wouldn't be talked about so much in the investment text, but if price is falling incredibly fast, you have to be careful that your stop loss might actually transact at a price worse than 50. So let's say the price is not falling steadily. Let's say the price is dropping from $51 and immediately drops from 51 and the next traded price is 49. It's a $2 jump, which in today's market would be crazy to have a jump of just $2 from one trade to another, because trades can happen in nanoseconds. I mean, just fractions of a second. If that happens, your market order goes in. Just think about the definitions of stuff and how this works. Your broker sees, oh, the stock is less than 50. Submit a market order to sell. Well, when you submit a market order to sell, you're selling at whatever the current price is. And the price isn't 50, is it? It dropped from 51 to 49, and that's when your stop loss triggered. So just because you have a stop loss at 50, please heed this warning if you are looking to trade and use stop losses a lot. Just because you have a stop loss at 50 does not absolutely guarantee that you will unload your position at 50 if the price is triggered. You might get a worse execution than $50. Now, it does protect you substantially. Usually it's going to be very close to 50, and it will almost certainly not be something like 20. I mean, I've never heard of a jump in price that much from one trade to another. But it is something you have to worry about. I hope this clears up some of the basic trading mechanics and order book mechanics a bit. If you are confused, please hit the discussion board hard. I will sit here and give you examples all day. I might even make a supplemental video where I kind of video myself doing some trading and I can show you order books and kind of go over this stuff again, but in real time on a real brokerage website. So yeah, quiz time, and we will jump to the next topic.